Chris Conway from the Australian Stock Report is joining us live from our Melbourne studio. Chris, good afternoon to you. Thanks for joining us. Now, it certainly looks like the Aussie market, as I mentioned, still in this period of reflection. It's just continuing to grind sideways, I suppose, as we wade through reporting season.
Good afternoon, Leanne. Look, I couldn't agree more. I really like the way that you termed that. It is very much a period of reflection. The Aussie market rallied strongly into the current reporting season in anticipation of the results being generally good, and I think that's how you would indeed term them. They generally have been good. Obviously, there's some outliers as always, but on the whole, they're more positive than negative. So we've got what we were expecting in terms of the market rallying into the expectation that they would be solid results. And failing there being another catalyst, i.e. even better results than what everyone was expecting, or maybe some macro factors, we are just grinding at the moment. So we're wading through reporting season. We're getting what we wanted, but we're not getting enough for the market to press higher once more. So yeah, that's where we find ourselves.
Now, we mentioned the broader index there. We're at about 57.80, but it looks like after a sort of period of a pullback, we're creeping back towards that 5,800 point mark. You've reiterated, or we've spoken to you about your bullish outlook previously, your target of 6,000. Is that still intact, and what gives you the confidence that we can actually get there?
Yeah, look, it is indeed intact, Leanne. I spoke to you about this target initially at the start of the year, and as the market dipped from 5,800 into 5,600, it wasn't looking like such a good prediction. But we have recovered, as I spoke about. We rallied into reporting season. I think we do still push higher. So my target is still 6,000. I think once we get reporting season out of the way, what we'll turn back to or pivot back to is rising markets in the US. US markets really are on a tear at the moment. There's some very strong evidence that they're going to continue higher, just in terms of patterns like the one we're seeing now with 9 straight rises on the Dow, what that has meant historically. I think when we were talking about the 6,000 target on the Aussie market, I was mentioning in the same vein 21,000 on the Dow. I think we finished 20,700 last night, so that's within shouting distance. I think if we get there, I think our market gets dragged higher, and I think, like I said, post-reporting season, we follow US markets higher.
I guess it's all dependent on Donald Trump's fiscal stimulus measures, though, isn't it? And those promised plans of tax cuts. If those promises, say, are not delivered, we could see quite a quick reversal on the market.
Yeah, look, it's interesting that you say that. I would tend to agree. A fair percentage of it would be tied to what he does regarding the tax plan and the massive tax plan, as he's termed it, and the big changes that are coming down the pike. But the other side of the coin is, everyone was so worried about Trump and all the problems that he was going to create. Wall Street, to this point, doesn't care. Wall Street has just pushed higher. They're not really concerned about what Trump has brought to the table thus far. I readily admit that tax reform is a huge shift. And anything he does in that space could potentially be a big momentum changer or game changer. So again, there is some weight that you would attach to it. But, like I said, by the same token, thus far, Wall Street hasn't really cared what Donald Trump has done.
Okay, let's move on from, I guess, the broader market moves, because it's a big day of reporting season, and I want to delve into some of the detail with you. Ardent Leisure is among those that we're watching there today. The stock's now down over 24%. Looked like a really disappointing result. And the one thing that was supposed to be a saving grace for Ardent was their main event division, and that even disappointed.
It absolutely did, Leanne. Look, I readily admit I put my hand up. I actually held Ardent up until about a week ago. I had liked the bounce from the lows. I had pinned some more hopes to the main event business, and I thought we were at the bottom of the negative news cycle in terms of the disaster that happened last year in Dreamworld. So they were the reasons why I was holding it. As we approached the results today, I became less confident in the main event business. And like you said, that was the one thing that was sort of propping up this business, was the expectation that the main event business would continue to grow and grow strongly. So, from the numbers today, earnings were up, but on a constant basis, they were actually down. So, the reason why earnings were up is because they opened more locations in the main event business, but I think on a constant basis, I know they actually fell, and margins contracted as well. So again, like I said, you took the words out of my mouth. The one thing that was supposed to be preventing this company from getting smashed, disappointed, and here we are with the stock down 25%. So it's not surprising. The only question people need to ask themselves now is, when does it become cheap?
And And what point would you look at it getting into it?
Well, that is $1 million question. I certainly wouldn't be buying it now on the back of just the intense sell-off that we've seen. Look, there will be value somewhere. Maybe the business needs to go through a bit of a turnaround. They've sold off their marinas business. They've sold off some other divisions. They've tidied up their balance sheet. Dreamworld will continue to hurt for a while. The last two updates, though, they have both said that whilst not obviously from the prior period a year ago, they are incrementally improving as we move forward in time away from the disaster. So, it's a tough one. It's tough to quantify that ongoing effect of the disaster at Dreamworld and just how long that will impact that side of the business for. And then the other big question, big question out of today's numbers is, what's going on with the main event business? Again, that was the thing that sort of people had pinned some hopes to. Disappointing today. Don't know where that price point is. Maybe $1.50. Who knows?
Yeah, all right. Well, it is the worst performance now, down close to 25%, $1.63 right now. Another one that's not doing so well is Flight Centre. They've cut their guidance. They've reduced their dividend. The market not liking the news. It's down about 4.3%. So shares likewise also crashing and burning.
Yeah, look, they certainly are, and this is not a new story with regards to Flight Centre. One need only look at the share price and look at the history of earnings drops, and it's sort of been all one-way traffic. For Flight Centre, it is a disappointing result. They blamed everything under the sun, a competitive environment, FX. I'm surprised they didn't blame Donald Trump as well, just to make sure they covered all bases. A really disappointing result. I do have to read a quote here, Leanne. You'll forgive me as I refer to my cheat sheet, but the MD spoke to increasing market share, this is in quotes, enhancing productivity, improving performance and implementing cost control measures. So the question that I ask in response to that is, should they not have already been doing these things in the first place? And if that is the only measure that the board has to combat the challenging environment that they face, I think some questions need to be asked. Why is the company not doing more? There are other operators like Webjet that reported today as well that have managed to do well under those same conditions. So what is fundamentally wrong with this business and why hasn't it been addressed sooner? Like I said, this is not a new script for Flight Centre. This has been going on for a while now.
Yeah, well, as you say, those are challenges really among the industry there, but quite vastly, I guess, differing results there from the likes of Webjet. Let's move on, though. I guess a similar kind of industry, Qantas, speaking of the airlines, a solid set of results, and what Mr. Joyce was referring to as a challenging environment, increased competition, but it looks like the turnaround story continues to deliver. What were some of the key highlights for you?
Yeah, so again, same sort of scenario. Alan Joyce did point to a challenging environment, but he also talks about the trifecta of turning around the balance sheet. This is throughout the three-year plan, turnaround plan that they employed. So they've turned around the balance sheet. They've rewarded their staff by paying bonuses and looking after them. And they've also drastically improved their customer service as well. He spoke in the press conference this morning about when he took over, Qantas being middle of the road and a bit hit and miss in regards to customer service. Now they're the leader in Australia and they're one of the best international airlines. So across those three prongs, he's really, and his team have really turned the business around, and I think that's what the market is liking. So revenue is down 7.5%. All right, you give him a bit of a pass on that one because of the challenging environment and the cost cutting that all major airlines have embarked upon, and the increased capacity on some of the major routes that Qantas flies. So, like I said, you give them a pass on the revenue. The profit number is down as well. Well, that harks back to the fact that they sold a terminal at Sydney Airport for $200 million in the last round of results. So down 25%, but you also give them a pass probably on that one. But it's the ongoing narrative that everything that they have said they will do, everything that they have tried to control, they have done and controlled. And hence why the stock is being rewarded today. In terms of a technical outlook, it's nice to see the stock also break above some resistance at $3.60. It's been unable to punch through that until today, that level, for quite some time now. I think it opens up some clear air, pardon the pun, up into about $4 to $4.25. So I actually quite like this one. I would happily be a buyer.
All right, fantastic. We're watching Qantas shares now up over 5%, $3.73, so certainly doing well off the back of that result. Chris, we're going to wrap it up there, but always great having you on and appreciate all your analysis. Thank you so much.
Thanks, Leanne. Have a good day.
Chris Conway joining us there from the Australian Stock